Hello everyone. You are a private investor on the channel. My name is Pavel. Today, we will talk about a topic that many investors underestimate, the risk of a sequence of returns or sequence risk. This is especially important for those who have already retired or are planning to live on passive income. Because even with a good average income, your capital may run out much earlier than you think. Later in the video, I will explain how this can happen and how to protect yourself after achieving financial independence. Please do not forget to like this video, subscribe to the channel, share your ideas in the comments on how to work with such risks. At first glance, everything is clear. Imagine that you have accumulated a decent amount and decided to live on passive income. Let's say, for all intents and purposes, that this is $1 million. And you see that your portfolio on average can bring in 4% per year of real return above the inflation rate. Naturally, you decide to withdraw these 4% annually. It seems logical that the money should last for a long time, right? That you can safely withdraw $40,000 a year and not worry. But no, in practice this may not work. After all, the average income is not equal to the real result, which can vary greatly from year to year. And the main problem is in what order the unprofitable and profitable years come. This is the risk of a sequence of returns. It is important not only how much interest your portfolio brings in a year, but also in what order the profitable and unprofitable periods come. The bottom line is that if the market falls in the first years of retirement, and you continue to withdraw money regularly, your capital may sink so much that it will not have time to recover, even if the profitability is high afterwards. I propose to consider a simple example. Let's imagine that there are two investors with the same initial conditions. Both retired with $1 million and withdraw $40,000 a year, that is, at 4%. At the same time, the withdrawal is indexed annually to inflation, and the inflation rate is 2%. However, investors began to live on passive income in different years, and the results of their investment portfolios also differed. For investor A, the situation is as follows. All the first 5 years, the market showed growth. At the end of this period, it almost came to naught, but nevertheless, there was not a single unprofitable year. The sequence of yields looked like this. As we can see from the calculations, the capital increased even despite the withdrawals, which also gradually grew. In general, in this situation, the investor calmly continues to live on interest, not really worrying. But investor B retired at a bad time. In the first year, the market falls, the portfolio loses 10%. However, then a smooth rise begins, and in the 5th year, there is a sharp increase in prices. But despite the fact that the portfolio sank in the first year, the investor still had to withdraw $40,000 a year, plus index this amount. In such a situation, when the value of assets is adjusted, they have to be sold at low prices, and therefore, in an increasing volume. This accelerates the eating of the portfolio. And even then, when the market recovers, investor B already has too little capital to receive the expected passive income, without the risk of spending all his savings. As a result, the portfolio's profitability over these 5 years turned out to be the same, an average of 3% per annum. But the final results are completely different. The first option is an example of a successful start. At the beginning, the market is growing, your capital is increasing even if there is a further downturn. You have already accumulated a cushion and are taking less risk. And the second option is a bad start. Immediately after entering the fire, the investor is waiting for the market to fall, and he still has to withdraw money. Therefore, capital is rapidly melting, and even subsequent growth may not save the situation. Why is it dangerous? The problem is not that the market is falling as such, but that you are forced to sell assets in bad years when they are worth less. And besides, you have to sell them more. It's like taking bricks out of the foundation of a house, then it can simply not stand. Therefore, the stronger the drawdown at the beginning, immediately after early retirement, the less likely it is that the portfolio will recover. What to do with the risk of an unsuccessful sequence of returns? The good news is that this risk can be mitigated. Here are some strategies. The first is to create a financial cushion. Store 1 or 2 annual expenses in a cash or short-term bonds. If the market falls in the first years, then at least you will not have to touch the shares. You will be able to live at the expense of the formed stock. You will also really need flexibility in spending. Plan for variable spending, cut down on expenses in bad years, and in good years, you can afford a little more. There will never be an unnecessary diversification of assets. Stocks, bonds, real estate, gold, all this reduces the dependence on a specific asset class. You can consider a bucket strategy. Divide the portfolio into buckets, into groups of assets by terms. In the first one, there will be assets that can be realized in the short term, in the next 1 or 2 years, in the next. In the medium term, which can be realized within 3 to 5 years, and the third bucket in the long term, this is 5+ years. This will include investments in stocks, for example. And of course, there are different withdrawal strategies, options for how to organize an annual withdrawal of funds from the portfolio. About one of the most effective approaches, about the Geitenklinger method, I wrote down a detailed analysis. I recommend watching it. In the long run, the stock market is growing, but if the first years are unprofitable, then even a good average yield will not save from the risk of premature depletion of capital. If you are not lucky with the sequence, the portfolio can quickly run out. This is especially critical in the first 5 to 10 years of life in early retirement, the so-called dangerous period. Therefore, when entering passive income, it is important to take into account not only the average return, without forgetting about risk management. If you plan to live on investments or just want to manage risks competently, be sure to take into account the risk of a sequence of returns. Make the stock tuned to the flexibility and think not only of interest, but also about the sustainability of the strategy of withdrawal. If it was useful, please like and subscribe to the channel. Also suggest topics and questions in the comments that would be interesting to sort out. Good luck with your investments and see you in new videos.